Good day, everybody. This is Jim Kinney, OptionProfessor.com content provider, and this is the weekly update for OptionProfessor.com on the market update. The date today, of course, is January 11th, 2019, the first podcast I'm having for 2019. I hope everybody had a great holiday. I certainly did down there at the Yucatan, soaking up a little bit of sun and enjoying myself. But it's good to be back, and let's get right into it because there's been a lot going on in the last week or so. First of all, let's take a look at the S&P 500 index. By the way, just as a reminder, past performance is not necessarily indicative of future results. There is a substantial risk of loss in short-term trading and option trading, and it's not right for everybody. So do be aware of all that. And today, of course, I'm giving you my opinions. Again, if you're listening now and you enjoy what you're hearing as far as having value, please let others know and let them know how to get the link, and we can expand our audience every time. Okay, thanks. All right, S&P 500. Quick review. When we were up in the 2900s, I told everybody that we were very overbought. The moving averages were way underneath the market, and that it was more probably than not going to have a decline. Well, that went from an overbought market to an oversold market when we went to 2300 area on the S&P 500. And it went not only through the moving averages in 2700-ville, but it went through it like a knife through butter, as you can see from the graph. Now, what have we done? Well, if you throw a ball off the Empire State Building, you're going to see it bounce, right? And that's what we're seeing right now is a bounce. Is it having trouble around 2600? Yes, it would. And why? Because that's the former lows right there. So this is a neighborhood where it could have some trouble and it could roll over. We have to keep an eye on that. With regards to what my feelings are we were in a range of 2900 and 2500, and now we're in a range of 2700 and 2300. And the market is going to meander between those 2 points. The VIX, which I'll get to in a minute, went from 10 to 36. And when you go from 10 to 36 in about a 90-day period, that's a lot of volatility. And what happens generally after a lot of volatility is a consolidation. Ergo, that's why I'm suggesting 2700, 2300 as a trading range for the foreseeable future. Okay, with regards to what would make me get back on the bullish camp, because, you know, all of these markets, and I'm going to run through the ones I look at right now. You can see we just got totally technically damaged in the stock market. Yeah, they're bringing it up a little bit so people don't jump out the window and sell everything. You know, if everyone got their statement when it was at 2300, do you imagine how much selling would have gone on in the first quarter of this year if they didn't rally this thing and make the statements go back up a little bit? I mean, let's be honest. There is a plunge protection team, more than likely, which includes, you know, the Fed and the Treasury and some of the other agencies, and somebody steps in and stabilizes things when things get way out of hand like they were down at 23 change, okay? So again, don't be misguided that this rebound is a renewal of the bull market. In my view, you'd have to get above 2700 and stay there for a while in order for me to get back on the bull train. Otherwise, it's a bear market bounce as far as I can see. Okay, now let's look at some of the other things that I'm looking at right now. I always look at the transportation average. Why? Because if people lose faith on moving goods and services, that's probably not good for the overall market. And the transports, their little bear market bounce has also started to roll over as well today. So you're down 77 on the transports. Okay. You know, again, you know, that's a lot of technical damage, Basically, you know, rather than Powell and everybody talking about the Fed and this 2% Fed funds rate and blaming it all on that, which is just stupid, what they should say is that the valuation of stocks were extremely high, and now those valuations have compressed. So companies are still making money. I mean, Amazon is still making money, but they're not worthy of 150 to 1 PE ratio, according to the market. And that's why the prices have adjusted accordingly. So this was an overvaluation correction, not a Fed funds correction. And again, I can't believe intelligent people who know the truth of that do not come out and bring that up to the general public, so the general public doesn't walk around with some kind of a thing in their mind going, if it wasn't for the Fed, I'd be making a ton of money. That's just not true. Okay, with regards to the transports, that's that. Now let's take a look at the Russell. You know, these things led us in the downside and it led us in the upside, the Russell and the transport. So that's why I watch them closely. Again, where are they stopping? They're stopping right where the area would be, 1450 or so. That would get you going here. To get me bullish on the Russell, you've got to get back above 1600, 1550, 1600, and you got to stay there for a little while. So these moving averages that are pointing straight down, that have had the death cross, which is where the 50-day gets underneath the 200-day, they start reversing. That's not going to happen on a quick bounce like we're seeing here. And ergo, the likelihood that we could revisit lower territories is, in my view, not off the charts. But again, when you are in the middle of a highway, it's not the best time to make big decisions. Meaning, if you're up at 1750, 1700, 1650, not a bad time to think about defensive strategies like I talked about, which is the collar strategy, where you sell the out of the money call and buy a put, or a married put, where you just simply buy insurance like you do on your car, like you do on your house, like you do on your life, right? Right. Now, when we go way down here to the low area, what's the thing to think about? Well, obviously, if you can't take the heat and you want to get out of the kitchen, if you get out of the kitchen, replace those things you're selling, if you think they're good companies, with long-term calls. That gives you what? Limited risk, so you can sleep at night, but it keeps you in the game. So if it goes from 1200 back to 1400, you don't feel like an idiot that you sold everything out at the bottom. The other thing from an option standpoint, if you find good companies that are way, way down and the put options have exploded, why not sell an out of the money put? That means you're agreeing to buy the stock at the strike price, less the premium, and you're either going to come away with stock or you're going to come away with the premium. A good case in point, if you're a real believer in Apple and it goes down to 140, if you looked at the 120 or the 100 put 90 days out, you might find a decent premium. And are you willing to buy Apple at 120 or 100? Well, if you are, that's a way to make a commitment to do that. And if it never gets down there, you'll keep the premium. Not a bad strategy. The other thing you can do is you can sell the put premium down there and buy calls. There you're still agreeing to buy the stock at the strike price, but that call, which you use the premium you receive to pay for, will hedge you against the market spanking back to the upside, which it's been doing a little bit. So there's a bunch of different strategies out there to consider, but in the middle of the road is not the greatest time to think of most any of them. So that's why right now is not really an optimum time to really buy or sell, in my view, unless you're an aggressive trader and you want to hit it because it looks like it might be running into resistance. Again, I can be reached at OptionProfessor@gmail.com. If you have any comments or questions or you want to talk to me directly, that's the way you do it. OptionProfessor@gmail.com. Okay, let's continue here and see what else I can show you. I showed you the Russell, I showed you the transports. Why don't we show you the NASDAQ? This is the NASDAQ index, and like all the other ones, you can see that they are going to have a nice death cross to the downside, and hopefully my machine will start kicking in so we can get the price. And there you go. Again, very similar to the other things, we've had a rebound rally. Where's the rebound rally taken us? Very quickly, up to where the former support was. So what does that mean? That means this could be a neighborhood where it has some trouble. And if it does, it'll go revisit some lower levels. Again, for me to get back on the bullish camp for the NASDAQ, I'd like to see it close above 7,500 and stay there. Then you can make a case for 8,000 or 8,500. Right now, you're making a case for a rebound rally. That's all you've made the case for, because obviously you're very, very oversold. We were very overbought up above 8,000. Below 6,500, we're very oversold. So now you're going back into the middle area. It may very well stay between the 6,500 area and 7,500 area or thereabouts and work off some of this excess volatility that's been going on. Okay. All right. So there you got the NASDAQ, there you got the Russell, there you got the transports, and there you got the S&P. Now, I'll just show you the VIX that I was talking about. I watch the VIX because it's the volatility index, and obviously I have a belief system on what it means. When you are above 25, you run the risk of a parabolic drop in the market. As you can see from this graph, when it gets above 25, you better watch. You better have some raincoat on and a good umbrella, and maybe get underneath the house here, because bottom line, above 25, it can go to 50. Above 25, it can go to 30. Above 25, it can go to 35, or it can go whatever it wants. But there's a lot of risk when the VIX is above 25. When it's between 17, 15, 17, and 25, then you're in a market that's generally going to be consolidating, in my view. If you get under 17 and down to 10, then I think you've got a rising market. So the VIX can be a decent addition to your technical indicator soup. And although you don't want to be enslaved to any one indicator, it certainly has value in my view. Okay, so there you go. Let's take a look at some of the other things like the interest rate market. You own bonds, you've been losing on bonds. Now, of course, they're moderating their talk. But again, my belief is now, again, the inflation news came out today, CPI, and it was a drop. But I keep noticing wages are jumping. In fact, they jumped twice the amount of the former report. So the bottom line is wages are continuing to climb. My feeling is that prices will climb because businesses who may see slower sales will increase prices in order to get that done, and at least try to do it in this quarter coming up. So I'm expecting Q1 in CPI or Q1 CPI numbers to go up. And that, of course, would be negative for the bonds and the notes. And as long as we stay above 2.5 on the 10-year note, I am going to remain bearish on the bond market. This is obviously, it got overbought up at 325 when the yields went up there, but that overbought has now turned into way oversold. So this is not the time, I don't believe, to get bullish on bonds. This is the time to reinstigate your shorts in the bond market and then use 2.5 as your get out point, because that seems to be a bit of a line in the sand. I'll show you what I mean by that by showing you a longer term graph. Let's go back 4 years. And on the 4-year graph, can you see this 2.5 area was the former highs a bunch of times? And I'm viewing that as a support area. So, and you see that little tail there? That little tail is not a bad tail if you're looking for a turning point. So again, what do I think of the bond market? I think it was very overdone up at 325, meaning the prices were very oversold. They've had a very big bear market rally, which has gotten people thinking. And of course, Mr. Powell looks like he's being more moderate. But again, don't forget, we've only gotten about 10% of the balance sheet reduced. And he thinks at the end of the day, his words, it's going to be substantially lower than it is now. Substantially lower than it is now, which means he's going to drain the balance sheet. What's he going to do if the inflation numbers pick up and the dollar rolls over? His hands are going to be tied. It's going to cause yields to go higher and probably invert. Here you go. So you understand where I'm coming from. 2.5 was the highs back here in 2015. 2.5 was the highs in 2016. And then 2.5 was the breakout point here. And you can see that it's come back down toward it. So this is not a neighborhood to get bullish on bonds. This is a neighborhood to reinstitute short positions, in my view. Okay, now again, you have to have a line in the sand. You have to admit mistake. You have to have humility on any trade. Okay, my humility will come in if we break 2.5. All right. And so that's the story there. Now, the last thing is the US dollar. US dollar. I've been telling you, it looks like it's going to roll over. Let's see what it looks like now. Okay, as I said to you on earlier broadcasts, I thought this thing was having trouble at 98. And then again, it tried to get through 98, tried to get 98. And I said the support. Now, this is a 4-year graph. I'm going to go back to the 1-year graph. But can you see on a 4-year basis, it's broken under 96. That's no good. If it breaks under 94, where is it going? I think it's going down towards 90. Is a dollar drop between there and 90 very big? It's a good size drop. What markets might react if that thing does collapse, and not collapse, but if it has a significant drop towards 90, if it breaks 94? Well, there's 2 things I'll show you in a minute. But can you see where I'm coming from here? Thing had a big rally. Right? Now he's talking about not hiking as much. So obviously that's dovish. That doesn't help the dollar. And we broke 96 where there was a lot of support. If we break 94, which is that point right here, it could accelerate to the downside. And that's what I would be looking at in the months ahead, if it can do that. If that occurs, there's 2 things that I think might benefit from it, possibly. One is the emerging markets, which obviously would like to see the dollar drop. And the emerging market here, you can see EEM is the ETF, and you can see it has double lows there, and you can see it's trying to pop up above 40. And let's just take a look at the moving averages to get an idea where it might be giving us a buy signal from that point. Now look at it, how it went from 52 when everyone was bullish in January. Look where it went down to. right under 40. What do you want to be, a seller down here? Maybe not. Why? Because it's already dropped. Okay, now, why would you want to be a buyer? If the dollar drops, it's supposed to be good for emerging markets. Look at the short interest. 14% is short. That's a big short interest. A lot of people to cover those shorts. Now let's look at the moving averages. You're above the 50-day at 39, right? And the 42 is right there. So if we can get above 40 and sustain ourselves, then these moving averages can invert and the 50 could get above the 200-day, and then you're off to the races on the upside, possibly. Okay, but this is the neighborhood to keep an eye on it, not to go to bed. This is not the time to cut bait. This is the time to go fishing, maybe. So there you go. That's something that would benefit, I think, from a drop in the dollar. The other thing would be the price of gold, which I've been telling you looks like it has been making a turn. Okay, so there's the gold on the ETF. These are the gold miners. Remember I showed you, if you've been listening, 17 was the low. Can you see it's surrounded by higher lows? So that's your point in the sand of a turning point. Now, can you see it's matriculating to the upside, higher lows, higher highs? We get above 23, and then it's off to the races, if it can do that. Let's take a look at the moving averages to see if that is going to be happening. Now, again, above 25 is really the number you can see on the left. If it gets above 25, then it's really going to get some legs, probably. Moving averages, 1920. So we're above both of them, but I'd like to see them invert, which means we got to hold water here. If we don't hold water, this is a danger spot. This is a spot where maybe you take your short-term gains, right? Because you can see there is some resistance around this neighborhood. But what I'm trying to say on a longer term basis, if you see it starting to trade above 23.25, then I think that you're breaking out of this, shall we say, sideways to negative action. And again, with a weaker dollar, you've got a reason to get into this stuff. So you get weaker dollar, keep an eye on GDX, keep an eye on what? EEM. They could be beneficiaries of a weaker dollar if we go from where we are now, which is a slight correction, into a more serious drop, which is possible. Don't forget, the budget deficits are not getting smaller. We're at the end of a cycle here. We got big economic growth. We shouldn't have big deficits now. And not only are we having big deficits, but they're growing. So that's weird, and weird doesn't work sometimes in the market. Now, the other thing I was going to bring to your attention here is what I believe, and again, everything is my opinion here, but since I've been in this for decades, I have some familiarity with history. The last time we had a big tax cut was 1986, okay? And what happened after 1986? Well, we had what? A big run-up in the stock market in 1987, a huge one, not unlike we had last year. And then what happened at the end of 1987? Well, if you don't know anything about history, and maybe you don't want to know this history because it's ugly, we had the big drop in the stock market, 20% drop in one day. Well, we had a 20% drop in the stock market, I think, recently, and more in some stocks. And we had a big run up. So it's kind of mirrored 1987 in some respects, hadn't it? Big run up after the tax cut, and then a fall apart. What happened to the dollar after the tax cut of 86? Dollar had a pretty good size drop the next year or two. What happened to gold prices after 1986? Had a pretty big run up in the next year or two. That's why I'm saying if history is repeating itself like it has a little bit in the stock market, because I would say that was a pretty severe drop from 2,900 to 2,300 is what? 600 points divided into your 2,900 using round numbers. And that's a 20% drop. Well, we had a 20% drop in the stock market back in 87. It happened in one day. This one took a month. Bottom line is, or a couple of months. Bottom line is that it rolled over in a big way at the end of the year after we had a tax cut in 87 and after we got our tax cut in 2017. Okay. And again, the reason for that is after the tax cut, people get extremely optimistic. And that means they bid up stocks to very high price earnings ratios, valuations. Then they drink coffee and find out that the party will not last forever. And they compress the valuation PE ratios, which they did in the fourth quarter last year. And when everybody wants out at the same time, there's an order imbalance and you get a very precipitous drop. Like 87, like 2016, like 2015, and like the last quarter in 2018. Okay, so that'll put a little bit more sense on what occurred rather than just hearing some stupid story that we hiked interest rates 0.25% and it collapsed the market. That's junk. It's stupid and it doesn't make any sense. Okay, Let's talk about some individual sectors. One sector that looks like it might be turning was the energy sector. And again, these are ETFs. I'm not recommending anybody do anything on these. These are for illustrative. You can see that on the energy, Vanguard Energy, it bottomed right underneath 75, and it looks like it's making a turn. Obviously, it's still in a protracted downtrend, so you can't get too excited about it, but it looks like they called the dogs off temporarily, and this thing pays 321. Another energy-oriented thing that I've been looking at is a BlackRock closed-end fund. It hit a 15% discount to the NAV. It went down to $10 a share. The distribution percentage went up over 9%. And as you can see there, that was a pretty good drop. Again, it's running into resistance right here at 12, so it very well may come back down. But at a 15% discount to NAV, and if you look at the companies and look in under the hood of this, you'll find there's a lot of big oil companies there. And if you go back on a 10-year graph, again, closed-end funds are a special investment. You got to look into them and find out all the use and all the risk before you consider it. But as an illustrative example, when things get bad, I look to find out things where I think the world's not coming to an end and there's value and they're on sale in a big way. Well, the lowest this thing ever hit was 10 back in 16, and it hit 10 recently. So 10 looks like an interesting number, doesn't it? Yes. And what about a 15% discount to the NAV? That means the liquidating value of the actual fund has a certain price, and that's called the net asset value. And then there's a market price. And if the market price is 15% under the NAV, you're obviously getting that particular fund at a discount of 15%. Also, the overall price is down at 10, and on a historical basis, that looks like a relatively low level. Third thing is, look at how high the volume is. That is a very high volume sell-off, meaning people panicked out of this thing. And people panicking out of things or into things generally is not exactly phi beta kappa. So that made this of interesting to take a look at. And again, the distribution yield was well above 9% when I was looking at it, and ergo that made it look like something worthwhile to take a peek. Again, big fast move up to resistance is not the time to initiate anything, but it is something that I would keep on a radar from the standpoint of if you think energy prices may have turned around. And then, of course, after you have the due diligence of looking into it and you find out if it's appropriate for you and la-di-la, la-di-da, all the suitability things you should do before you invest in anything. All right, now let's talk about some other things going on here. Some people have been liking REITs lately. And these are all, some of these are Vanguard, but there are many REITs out there. This thing distributes at 491 according to my screen. It went to as low as 70. You can see that area there, and some people are starting to take bites into this area as well. With regards to the consumer, everyone thought that the consumer was going to be on fire, and so the retail consumer discretionary stuff got whacked pretty good, going from 182 down towards, I think, 140 here. Let's take a look. Yeah, hit 140. It looks like the consumer might be back in business, but again, we've had a sharp rebound back to resistance. And this is a tough place to make big decisions because you don't know if this resistance is going to hold and we're going to go back into the soup. It's possible. That's why, it's not the best time. But can you see the highs over here? We're at 140, and that was a reasonable area to take a bite right around there. Okay, that's your consumer discretionary. How about healthcare? Because these drug companies certainly are increasing prices from what I've been hearing. I've done a little scanning of my own at some of the different pharmacies, and drug prices are supposed to be raised. So looking at different healthcare ETFs, just look at one here. Now, again, they'll have many different things, not just the drug companies. You can go into just a biotech, or you can go into just I'll show you a couple of drug companies and biotechs now, but here this thing as well went down towards 148, and now it's at 163. So it does seem like they're trying to bounce it. Let's take a look at some individual stocks real quick. And the bigger ones here, Biogen, let's see what's going on with them. Again, they're trying to get going. They've got a lot of cash, so they're making a lot of purchases. Bristol Myers Squibb made a big purchase, and I think the shareholders weren't too keen on how much they spent on that one, because as you can see, the stock is down at 47, and it used to be way up here, so it hasn't really helped them yet. They bought, I think, Celgene, and then let's take a look at Pfizer, which is one of my favorites. And Pfizer's doing pretty darn good. Let's take a look. It's paying over 3% dividend, so that's nothing to be shameful of. And then, of course, the moving averages look pretty good. So, that's one of my favorites in the drug area. And as you can see, there is trading above both moving averages. Again, nothing huge, but this 40 areas, you're good. A good line in the sand. And you could protect yourself with covered calls or a collar strategy or something like that. Try to make some money on it and see if you can capture the dividend plus a little extra income off the covered right. Learn how covered right works, learn the use, learn the risk, and then take it from there. With regards to another one that people look at all the time is Amgen. Let's just take a look and see if that's doing anything. And Amgen looks like it's trying to take off a little bit there. And it had its big drop to 163. So there's your line in the sand right now, really at 180. You don't want this thing back into 180. And it gets above 210. It looks like it could be off to the races. So this could be a company to keep an eye on if you're interested in biotech. And of course, it's one of the leaders. And if you look at most of the big funds, it's one of the big holdings in most of the funds. Let's just take a look at the moving averages. And they're at 188, 189. You're at 199. So there's your lines in the sand, 189, 188. And there you go at 199. So if it can keep going, there you go. All right, let's briefly, because I am running out of time here today a little bit, go over, again, a couple of other things like the banks, the financials. Here's your financial select. And as you can see, it's trying to make a turn here, but again, it's still having trouble. Now, again, a lot of these companies are trading under book value. I think they said Citigroup is at around a $61, $62 book value and is trading in the 50s. So they do seem like they're on sale. But I think what the fear is if short-term interest rates continue to climb, these people are going to have to pay on their deposits, which are where they had not had to pay at all before, and loan demand's not going through the roof. And so it could hurt their profitability looking forward. But it does look like a pretty good washed out low at 22. And so there's your line in the sand if you want to take a bite into the financial sector. But again, it's still in a primary downtrend, and this 25 number looks like it could be a problem. So again, not the greatest time to take a shot at it because the trend is still down, and that low of 22 is fairly recent. But it does look like a possible turn is going on. And according to valuations, people do feel that some of these companies are of good value now. Their earnings are going to be coming up very soon, though, and they start announcing or downgrading their forecasts, then obviously these things are still going to be a little problematic. But if it's already had a big drop, it's gone from 30 to 22. That's $8 into 30. Whenever you get 20, 30, 40% underneath your moving average, it's time to look at the buy side. And when we hit 22, we were, 26% underneath the highs. And that's a pretty good size drop. And that's why some people start taking a look at these things when they get this far away, either above or below. Good case in point was Amazon. And Amazon, when it hit, I'll give you a quick thing on that and then go from there. Well, let me just tell you, Amazon hit 2050. The moving averages were at 1550. I told people that's way, way overdone. Consider your collars, consider your married puts. Was that a good idea to look into? I think so, because we lost 700 points off of that. And those who looked into collars and puts when it was way up are certainly in better shape than the people who just sat tight. All right, we are coming to the end of the broadcast for today. And I did want to thank everybody for coming. And I do want to encourage you to let others know what's going on as far as the broadcast each and every Friday. Also, take advantage of the email. optionprofessor@gmail.com. You have questions, you're trading on your own, you need a little bit of insight, you want to talk, again, I can show you the use and the risk of things. And then, of course, you'd make your own decisions on whatever you want to do. You know your suitability, and so does your broker. Okay. Until next Friday, I would like to thank everybody again for being here. Have a great weekend. I'll be back in the saddle with you next Friday. We'll see what's going on. Until then, good luck and good trading.